Will the Federal Reserve cut rates in September? Will the Democrats field a new presidential candidate? And how will markets react? Lots of questions today for Anna Rathbun of CBIZ. I'm Lisa Bernhard with Reuters. Anna, let's start with the Personal Consumption Expenditures Price Index, a mouthful, the Federal Reserve's preferred inflation gauge. It showed that prices were flat in May, and the annual rate ticked down to 2.6%. Traders have now upped the chances of a Fed rate cut in September to nearly 70%, but the Fed has already said that it would cut rates once in December. Would the Fed walk that back and potentially cut rates in September before what is looking to be an even more heated, if that were possible, presidential election in November?
Well, the PCE number today was certainly a good number, 0% month over month, and then 2.6% year over year. That's happy news for those who are waiting for Fed rate cuts. Now, the Fed, interestingly enough, the Fed actually said 2.8% by the end of the year. So 2.6% is actually a really good number. But the Fed needs more than that. It needs conviction that inflation is going to stay put and stay low. So what does this mean in terms of rate cuts? September rate cut, in my opinion, is still a little too soon. Between now and September, anything can happen. And we really need several months of stable prices, stable inflation numbers, I think, for the Fed to have conviction. Some of the Fed officials have said that they need several quarters. Now, several quarters might be very, very hawkish, and we are still looking at, maybe 2 more quarters of 2024. So 1 cut in December, still very likely. 2, maybe. 1 in September, probably unlikely.
All right, let's circle back to the election, because the headlines today are obviously saying that Biden had a shaky performance and that Democrats may be scrambling behind the scenes to replace him as the presidential candidate. Markets, as we know, like certainty. That's a well-worn phrase. If he were replaced, that takes what was already looking like a very uncertain election in terms of the outcome into more uncertain territory. What are the implications then for the markets?
It's unusual to have presidential debate in June, so it was a little bit of a wild card there. And certainly the performance of President Biden has put the Democratic Party in a difficult position, let's say. The American political system and the American economy is a lot deeper, larger, and stable than just the presidency or just the White House. So I just heard this recently, which I'll share with you. Warren Buffett has said that he has invested through 14 presidents, 7 of them Democrat, 7 of them Republican. Over a long period of time, he has been a successful investor. So what this means is that even though there may be uncertainty in who the candidate might be, and I guess we will find out, at the end of the day, who is in the White House may have little impact on where the markets actually end up.
Given how high-flying the market has been, albeit it's been a very narrow market, how much of a pullback do you see, though, coming up in the coming months?
Well, when you have a narrow market, it means that you have just a handful of stocks that are really leading the way. So where the S&P 500 is sort of misleading if you consider all 500 stocks instead of just a chosen few at the top. Now, the risk of volatility really lies with the fact that those stocks that have run year to date may be so overvalued that when there is a market turn in sentiment that they may fall too much. And so the risk of volatility definitely comes with a narrow leadership. And the thing about the market is anything can trigger that. Anything can be a catalyst. The election could be a catalyst. Anything can happen this summer that could be a catalyst. But it's really the narrow leadership that is really the culprit of a potential volatility, rather than the S&P 500 just having a bad day. I think if all 500 stocks had gone up, maybe not equally, but in similar dynamics, potentially the diversification of the upside may also lead to the diversification of the downside, which may mitigate it.
Let's take a look at a couple of individual companies making headlines, because Walgreens cut its profit outlook and it's closing underperforming stores, and Nike shares are set for their worst day potentially ever on gloomy sales forecast. Are these company specific, or are they signs of a broader consumer pullback?
Yeah, so Walgreens, it seems to be a little bit of both idiosyncratic as well as consumer weakness, which they actually cited. Now, another company, Nike, it seems that it's a little bit more of potentially not wise choices in where to concentrate their products, right? So that's a little bit more idiosyncratic. But they actually follow a trend of other stocks and other companies that have reported weaknesses in consumers, right? So we're talking about Walmart, Home Depot, Amazon, Target. And then we have companies like McDonald's and Wendy's. They're bringing back the $5 value meal. Maybe it was $3 at Wendy's, but these are value prices, right? So this paints a picture of a consumer or the American consumer that's really financially strained, is really looking to stretch that dollar, especially with the delinquencies going up in both credit cards as well as other loans. This is something that we need to pay attention to as something more than idiosyncratic.